This is Asia Trade. I'm Shery in Tokyo with Haidi Stroud-Watts in Sydney. Take a look at how we're setting up for the Asian market opens. We'll be watching those automakers off the back of President Trump's comments at his rally, marking his 100 days in office. When it comes to automakers, he said that he wants to give them a little bit of a break and time on tariffs. He's signing that executive order easing the impact of his auto tariffs. You can see right there, the offshore yuan is holding at that 726 level. When it comes to Nikkei futures, under a little bit of pressure force coming back from holidays. We'll also be watching those semiconductors. We are expecting Samsung Electronics to come out with earnings. We could be seeing the first net income decline in about a year. When it comes to those U.S. trade tariffs that we have seen from the Trump administration, he talked about really wanting to push back against China. Take a look at how U.S. futures are setting up. We have seen the best six-day gains since 2022. All of this, of course, at a time when we are also expecting big tech earnings. When it comes to Japan, he said that America loves Japan, but he wants cars to be built in the United States, a sort of narrative that he's continued throughout his speech today, marking his 100 days in office, talking about investments coming into the U.S. from the likes of TSMC, Amazon, NVIDIA as well. Take a look at NASDAQ futures down 0.4%. We have seen the NASDAQ 100 lose almost all of its gains since President Trump came to power, and of course since the April 2nd tariff announcements from his administration. But take a listen to what he specifically had to say about Beijing.
With my China tariffs, we're ending the greatest job theft in the history of the world. China's taken more jobs from us than any country has ever taken from another country. And that doesn't mean we're not going to get along. We get along with China. I mean, their tariff now is at 145%. So essentially, that's a big difference between that and zero. But I think it's going to work out. They want to make a deal, and we're going to make a deal, but it's going to be a fair deal.
Let's go straight now to Bloomberg's Tyler Kendall, who joins us live from Michigan. And President Trump, for almost an hour, they're clearly speaking to his base, to his supporters. What was the takeaway, and what was the takeaways for everyone else?
Right. Well, this really did feel like one of President Trump's signature campaign speeches. We often talked about the so-called weave. He really hit on a bunch of different issues. Even him himself said that it felt like the campaign and that he missed it. He did, though, try to hone in on the economy. I can say when you look around the arena here, most of the messaging on the wall does have to do with his economic agenda when it comes to investing in America, building in America, hiring in America, as this administration really is trying to tout its policies, but also at the same time defend them on some levels amid a flurry of recent polling really showing that American consumers are growing increasingly wary when it comes to his tariff policies. President Trump did say that he felt that those polls were biased, but if we look at consumer sentiment data from last week, for example, showing consumer sentiment sliding as well as long-term inflation expectations rising. But this administration really trying to make their tariff policies about the idea of reshoring production into the U.S. In fact, President Trump during this speech saying that automakers will be, quote, slaughtered if they do not onshore production and fast. It comes after earlier today, he did take some step to ease some of the pain when it comes to his tariffs for automakers, including signing an executive order that essentially would prevent the so-called stacking of tariffs on top of each other for automakers, such as the 25% tariff on steel and aluminum. And the other part of this is as the administration defends its tariff policies, they are also pushing forward their tax agenda. And President Trump made some pretty important headlines at the end there, saying that ultimately Medicaid will not get cut in a reconciliation package. That's going to be a very important theme that we're following because this White House is really banking on getting reconciliation through to complete what it says would be its full economic agenda, that two-prong approach when it comes to tariffs and tax cuts.
So, Tyler, when it comes to actual accomplishments in the last 100 days of office for President Trump, what are you seeing in America on the ground? You mentioned some discontent by consumers as well because just these price gains continue.
Right. Well, one of the themes of this first 100 days is that President Trump has moved very quickly. Often the administration calls it Trump speed. And that can be both sort of a feature and a bug, because on one end, it has let him issue many executive orders, including when it comes to deregulation. That's one area that we've seen particular progress on that President Trump has been able to enact unilaterally. But on the other end, of course, it has created just so much uncertainty, which has really left consumers, investors, and retailers alike feeling that unease when it comes to the future of what those economic policies can ultimately look like. Because up to this point, President Trump really, for the most part, has taken most of this action unilaterally. But as we were just discussing, that reconciliation package is going to be very important for this White House to accomplish some more of its concrete goals. And he's going to need Congress's help. And I'll tell you exactly why. They're going through this with the reconciliation process. And that means that there's very little room for error here with Republicans. Essentially, how the process works, it's going to be a fast track of that bill, which means that they're not going to court any Democratic votes. So this administration really trying to push that out as quickly as possible. The Treasury Secretary Scott Bessent saying yesterday they want to see that done by July 4th. That is considered a very ambitious goal to get all of those priorities done.
Bloomberg's Tyler Kendall there in Michigan. Let's bring in from the markets view Garfield Reynolds, who leads our Markets Live Asia coverage, and it has been a frenetic 100 days. I mean, how are markets feeling at the moment? Stocks-wise, Asia-Pacific has pretty much reversed all of those losses since the announcement of the tariffs, but what lies in store is something else.
Well, it's interesting, Haidi, there's kind of a twin-track process, as it were, for markets in that they rushed to price in what looked like pretty much a worst-case scenario with the April 2 announcement of those, that range of tariffs for different countries. Since then, there's been some further missteps, but then a sort of gradual and now growing optimism that the ultimate tariff toll will be significantly less. So the auto exemptions, adjustments, whatever you want to call them, those are, like another example in that direction. So you have investors going, okay, we've had the bark, maximum bark, but the bite is not going to be so tough. But then there's the other track is, well, what is actually going on in the real economy? And there is unease for American investors in particular, I think, or investors in American equities, about what happens when the Chinese ships stop turning up in US ports, which is expected to hit home next month. And there is also this backbeat of concern about China. In amongst everything else, somehow people are looking past the 145% tariff on China, which President Trump mentioned, and which basically means that the US is looking to cut itself off from one of its single biggest supplier outside of Mexico and Canada, of a whole range of imports which it can't readily replace. How on earth that works out and how that doesn't lead to a revival in inflation and a slowing of growth, that's the $3 trillion question, as it were, for the US economy and also for anybody who's investing, not just in the US economy, but in the global economy.
Garf, despite, of course, the rebounds that we have seen in some risk assets, why is it that when it comes to King Dollar, we're not necessarily seeing it make that comeback? It's still down about 10% in the last 100 days.
Yeah, for the dollar, I mean, there's a couple of things going on there. One is that seriously lower growth expectation for the US, and to some extent what's gone on when it comes to US equities in particular has been growing bets that the Fed will end up cutting rates sooner rather than later, and that it will end up cutting more than the Fed has been saying it would do because the economy is going to slow. So that helps both US bonds and US stocks. Doesn't help the US dollar, because if the solution to the economic pain delivered by the tariffs is Fed rate cuts, well, that's a dollar negative. There's also the broader situation where there's plenty of commentary coming out of the US administration that in general the dollar has been too strong for too long. That's part of what's helped to wither away the US manufacturing base that they now want to bring back online. And there's also the straight volatility. The US dollar was a haven because it was seen as being where you can go to get away from volatility when there's a crisis, because you can be sure that the Fed will not only respond to the US situation, but to the global situation. Think COVID, think GFC. The Fed led a global central bank shift in order to deal with those problems. For that matter, the Fed led a global central bank policy shift in hiking rates to deal with inflation. So that leading role for the US polity is vanishing with President Trump's isolationist bent. So President Trump's policy volatility is also persuading investors that the US dollar, it's not that they're avoiding the US dollar, but they don't want to pay up when they go into it. They'd rather go into the yen, the franc, the euro, all of which, this is very old school when it comes to currency trading, all of which have large current account surpluses. That means you can be sure of getting in and out of those currencies without necessarily paying your extra for those moves. You're not going to move those markets because of that current account surplus. So that's a big part of what's happening in the global currency space, and why there's a strong expectation that the dollar will keep on going down. Tomorrow's Bank of Japan meeting is going to be interesting in that context, especially when you consider that speculators tracked by the US CFTC are longer the yen than they have ever been. And on a positioning basis, it's one of the more extreme one-sided bets that has been recorded in data going back to the 1990s.
Bloomberg's Garfield Reynolds there. Take a look at some of the other stories that we're following. And Amazon says it will not display the cost of US tariffs on products after President Trump called Jeff Bezos to complain. Shares paired earlier losses inflicted as the White House described the idea as a hostile and political act. The proposal was initially reported by Punchbowl News, but the company now says the tariff label is not going to happen. Bloomberg has learned that President Vladimir Putin is insisting that Russia take control of 4 regions of Ukraine it doesn't fully occupy as part of any agreement to end the war. The demand deals a blow to President Trump's efforts to reach a ceasefire. Sources in Moscow say US envoy Steve Witkoff tried during lengthy talks last week to convince Putin to agree to a ceasefire based on the current front lines. Spain's power grid operator says a series of disruptions over a few seconds triggered Monday's widespread blackout, which spilled over to Portugal. However, Red Electrica says it still doesn't have a complete explanation. The Spanish government is not ruling out a cyber attack, although the grid operator denies any hacking. Prime Minister Pedro Sanchez has denied opposition claims that expanded wind and solar generation were to blame. The European Union's top court has banned so-called golden passports for wealthy immigrants. It's ruled that Malta's program for investors is illegal because it renders nationality as a mere commercial transaction. The US, meanwhile, is offering a so-called Trump Gold Card, granting residency and a path to citizenship for investors paying $5 million. More ahead here on the Asia Trade. This is Bloomberg.
Breaking news out of Japan. Industrial output and retail sales surprising to the downside. Industrial output contraction of 1.1% month on month. A contraction of a smaller amount was expected by economists. Of course, we continue to see uncertainty surrounding the tariff campaign from President Trump. And of course, also we do have the 25% levy on U.S. imports of steel and aluminum. And of course, a baseline 10% tariffs on all goods as well. Retail sales in Japan contraction of 1.2% month on month. The estimate was for a smaller contraction, but we are now seeing consumers here in Japan being hit by the soaring costs of living. We have seen price gains across Japan staying above that BOJ inflation target for more than 3 years. We'll be watching really semiconductors and automakers when trading gets underway in Japan and South Korea. Of course, we are still expecting Samsung earnings anytime now, expected to report first net income decline in about a year. Also, we'll be watching those automakers as President Trump is easing some of those tariffs on car makers. We have the market opens next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens as we're still digesting President Trump's comments at his rally, marking his 100 days in office in Michigan. And Haidi, really, we heard everything, almost a campaign-style speech where he defended his economic policies, including the tariffs, saying that China wants to make a deal.
Yeah, saying that they still get along, but that China really wants to make a deal. He said that, in terms of the jobs that is perceived by him to have been taken by China from America. So really very much kind of drilling down in the messaging to his base, right, Shery? The question is sort of how markets will contend with this, given that there was also a fair bit of, Fed bashing, saying that Chair Jay Powell hadn't done a very good job. So that leaves potentially Treasuries looking a bit more vulnerable again.
Yeah, we're looking at the U.S. dollar as well. And what's on the other side of the trade, the Japanese yen holding at that 142 level. Pretty range bound, of course, after topping 140 last week. This coming at a time when we do have the Bank of Japan policy decision just tomorrow. No change expected at this point. We did get industrial output and retail sales numbers earlier today, missing to the downside, and all at a time when, of course, the trade negotiations continue with the United States. We are watching those automakers because President Trump is now signing that executive order easing the impact of his auto tariffs. We're also on watch for semiconductors, not only in Japan, but take a look at South Korea coming online after that session of gain that we saw in the previous day, all at a time as we're expecting Samsung to release their earnings at any point now. Usually they come a little bit earlier, but the expectation right now is for net income to decline for the first time in about a year. Of course, we continue to watch that semiconductor story, especially when it comes to certification of their most advanced chips to NVIDIA. We're also watching, of course, their smartphone sales as well. The Kospi down 0.2% early in the session, Haidi.
Take a look at how we're tracking when it comes to Australia. We've now sort of hit midweek, which just means a couple of more days until we get to that Saturday federal election vote. And this is a picture as we see that sort of staggered session looking unchanged as we get online here in Australia. ASX 200 at the moment looking pretty flat. The Aussie dollar actually on the front foot this morning, 63.86. As you say, Shery, we're seeing those question marks when it comes to where to next for the greenback again. And as I mentioned, when it comes to treasuries, potentially we are seeing a little bit more fragility there after we had sort of some comfort being felt for some parts of the markets when it comes to US assets, with the assurance that Fed Chair Jay Powell would be keeping his job. But at this rally marking the 100 days of the Trump presidency the second time around, we did see that criticism from the president over Jay Powell, saying that he's not really doing a good job, that he knows more about interest rates that Powell does, and that defense of his broader economic plan as well.
Let's bring in Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank. Vishnu, of course, we're still digesting the first 100 days in office for President Trump in his second term. When you're looking at the markets, has anything fundamentally changed? I mean, Haidi just alluded to the Treasury's dynamic, to the U.S. dollar, that exceptionalism narrative, perhaps under pressure.
I mean, yeah, Shery, that's a really good point, which is one of the big things that's come through is exceptionalism of the U.S. Has been, challenged immensely, and the knock-on impact has been on the dollar. What has been far more worrying earlier, which has now subsided though, was the simultaneous sell-off in both U.S. dollar and U.S. Treasuries. That has eased up somewhat, so that's the relief. And I think for anyone watching the markets, any signs that the negative correlation between dollar and USD yields is reinstated due to a loss of confidence, that kind of dynamic would be very worrying. In other words, if they see another episode where both dollar and US Treasuries sell off, leading to meaning simultaneously seeing rising USD yields and a dropping dollar, that would be very worrying as a sign. I think whatever we are seeing right now is really a rationalization of the economic headwinds that are gathering in the U.S. amidst falling, U.S. confidence. So that's really what we're seeing. And I think the point you made earlier about Fed Powell under attack in the speech, what markets are probably going to need to dissect and get a good grip on is whether this is just simply Trump deflecting blame for a slowing economy, or it is a little bit more sinister than that, in which case large risks could loom ahead.
Risks such as what, and what do you mean by perhaps more sinister measures could lie ahead? Are you thinking more of a dismissal of Fed Chair Powell, and what are the implications also for global markets that are watching?
Well, what's really worrying is, Trump doesn't even need to go as far as dismissing Fed Chair Powell, and one of the things he just needs to do is, plant the seed of doubt about Fed independence, insofar that saying that enough bullying could lead to a shift or sway in the Fed independence. But for the next year, it's really a
right, Vishnu,
highly unlikely event that Fed Powell will be dismissed.
Let me interrupt you for a second because we are getting that much awaited Samsung number for the first quarter. Operating profit coming in at 6.69 trillion won. When it comes to net, coming in at 8.03 trillion won, which is actually ahead than expectations of around 5 trillion won. We were expecting the first net income decline in about a year, so we'll be comparing those numbers with what we got last year. But at least when it comes to the operating profit side of things, it's a beat of 1.1 trillion won. The estimate was for only 673 billion won. Also a beat when it comes to net income as well. When you see the divisional breakdown, chip sales 25.1 trillion won coming in line with estimates. We're also watching their mobiles networks operating profit coming in ahead of expectations. Vishnu, we were watching this semiconductor story unfold not only in South Korea with Samsung, SK Hynix, but of course Northeast Asian economies, including of course TSMC in Taiwan and some of those tech names in China as well. When you look at different sectors and the different potential of disruption from these tariffs coming from the Trump administration, how does the tech narrative play out in the next year?
I mean, that's a really good question, and I don't think we've got perfect clarity on that. What we can assume is there will be a certain degree of front-loading and inventory building. Beyond that, I think it would come down to really the precise nature of the tariffs, or whether further sanctions are erected, and whether some of the trade deal conditions would entail, starving China of some tech, which means there's going to be a headline impact on some of these semiconductor producers as the China markets become less viable if they were to go along with the US. So the problem right now, I think, for many involved is twofold. One is the lack of clarity in terms of what the restrictions would be over and above the tariffs that might be imposed. So there's a cost and an excess issue. Then there's also the issue of how China might try to work around it and what that means for Chinese producers of tech, because we have seen before that China would have in place plans for a workaround, and some of these sanctions and tariffs might just be accelerating those. And these are the conditions under which the industry uncertainty is hobbling longer term planning and horizon for investment.
Vish, when it comes to any sort of hopes of a détente between Beijing and Washington, do you ascribe any hope to that? Because while we've seen overtures from Scott Bessent, for example, a lot of this can be kind of seen as being, not really offering much incentive for Beijing to come to the table. And in fact, some of the domestic commentary has been setting up for, digging in for a protracted war.
Yeah, I mean, Haidi, unfortunately, it does look like the current state of rhetoric from the U.S. Will probably stymie any progress towards Beijing coming for talks. I mean, to be very clear, I think China sees this trade war and tariffs as being pointless, and so making a deal is in the interest of Beijing. And I think, to be fair, they've accepted that, although the condition is it must be on equal footing and under fairer conditions rather than just a unilateral imposition of restrictions, which is where we are right now. And that's what would get in the way. And also we need to bear in mind, unlike Trump 1.0, where the benefit of the doubt was given to Trump and probably being discounted as being a Trump thing. This time, Beijing knows that this is about lasting industrial advantages which they cannot concede. And that means that the positioning of Beijing will be more strident. And that would also raise the bar for a quick deal to be arrived at. As it is, I think trade deals are long and arduous processes. So this is why I think markets are somewhat circumspect or cautious about a quick turnaround in the situation.
Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank. Really good to have you with us. We continue to watch Samsung. We're getting the latest lines from management saying that global trade tensions really make it hard to predict the future, but they do expect performance to improve in the second half. This is as they just reported first quarter net coming in at 8 trillion won, beating expectations. Also, when it comes to their operating profit, it beat to the upside, coming in at 4.3 trillion won. Samsung saying that export controls on AI chips have led to HBM sales slowing down. Chip sales in the first quarter coming in at 25.1 trillion won as well. Let's bring in our next guest who has a neutral rating on Samsung and the target price of 48,000 won. With us now is Mehdi Hosseini, Senior Equity Research Analyst at Susquehanna. Mehdi, great to have you with us. So what do you make of Samsung's performance in the first quarter? They seem to have beat to the upside, but I do wonder how sustainable it is given the uncertainties in the trade environment, not to mention their ongoing struggle to get certified by NVIDIA.
Yes, thanks for having me on the program. Obviously, their reported operating profit was better than expected, and I do attribute that to some of the demand pull forward. My problem with Samsung is the rate of recovery. I think Q1 could prove to be the bottom in quarterly earnings. It is the rate of recovery that Samsung is going to lag when compared to the peer group.
Available cash.
Let's talk a little bit about this broader business. How is the DRAM market doing right now, and what does it mean if Samsung, as you said, lags behind peers?
Right. As widely known, Samsung still doesn't have much exposure to NVIDIA. Most of the AI exposure they have is to the ASIC solution. So they are shipping HBM, DRAM, but they're shipping it to lower spec used for ASIC application. And also, what is interesting, commodity DRAM prices are actually tracking better than expected, simply due to the fact that demand has been pulled forward ahead of the new tariff regime going into effect. So I think Samsung is benefiting from some of the near-term pricing trend. They are benefiting from non-NVIDIA AI demand, but I'm not sure if this is sustainable. And it is the rate of recovery that is a question. Just to put things in perspective, in the prior peak in 2017, about a third of Samsung's overall revenue was driven by semiconductor business, but semiconductor accounted for 65% of operating profit. Fast forward to 2024, last year, reported numbers, the semiconductor accounted for 43% of revenue, but an operating profit from semiconductor was also around 40%. So it is the margin that is the problem, and since Samsung doesn't have exposure to NVIDIA, I think is going to put a cap on margin recovery.
Mehdi, we're now hearing from Samsung talking about export controls on AI chips really leading to the HBM sales slowdown, that global trade tensions make it hard to predict the future. How complicated is the outlook when it comes to the macro environment, the geopolitical environment, and the prospect of further measures either from Beijing or from Washington in this step of the tech and trade war?
Right. Obviously, the tariff and increased restriction on AI-related products would impact everyone. It's not just limited to Samsung, and it is more like a five-dimensional chess game. I'm not that smart enough to be able to sift through all the moving parts. But one thing that separates Samsung from the peer group is not being qualified at NVIDIA. NVIDIA is going through a product transition. Hopper is migrating to Blackwell, and that's where the Samsung has a disadvantage. And that's what, unfortunately, separate Samsung from the peer group do have exposure to NVIDIA. So having everything equal, the tariff would impact everyone, but the Samsung lack of exposure to NVIDIA that is a headwind for Samsung when compared to the peer group.
Do you see more upside when it comes to the mobile division, that we might see more sequential growth, particularly if there's more business in the pipeline from a potential foldable from Apple?
I'm not sure. Like I said, there is a demand being pulled forward across the board, and it's just Samsung seeing it. Everyone is seeing buildup of inventory in advance of the tariff or new tariff regime. It's for a smartphone, for a notebook, and also for the components that go into the smartphone and notebook. As I said, commodity DRAM prices are actually tracking better than expected because of that demand being pulled forward. I think the question is, well, is it a 1 quarter pull-in? Is it a 2 quarter? I think we could have a couple of quarters of demand pulled forward, and unfortunately, this pushes out that correction. Probably, maybe 26 will be a challenging year because of the demand being pulled forward. But again, the tariff is a big question mark. We may not see any resolution here for a couple of months, and this is what's causing the demand being pulled forward.
Mehdi Hosseini, good to have you with us, Senior Equity Research Analyst at Susquehanna. We continue to watch those tech names broadly across Asia, specifically Sony. We have heard from sources that it could spin off its semiconductor unit at a valuation of up to $49 billion. At one point today, it was gaining more than 6% with that jump from this news. Now, Bloomberg has learned that the spin-off and listing of Sony Semiconductor Solutions could be occurring as soon as this year, with Sony potentially distributing the bulk of its holding to shareholders and retaining a minority holding. We have more ahead on the Asia trade. This is Bloomberg.
China's taken more jobs from us than any country has ever taken from another country. And that doesn't mean we're not going to get along. We get along with China. I mean, the tariff now is at 145%. So essentially, that's a big difference between that and zero. But I think it's going to work out. They want to make a deal, and we're going to make a deal, but it's going to be a fair deal.
President Trump, they're talking about a trade deal with China as he marks his first 100 days of his second term. Let's bring our Bloomberg News Desk editor Dill Desis joins us now for more. And it was another marathon address from President Trump, and he sort of positively harked back to it almost being like being back on the campaign trail again. What were the sort of the major takeaways, given that a lot of the rhetoric was very much geared towards his supporters?
Yes, well, really, I mean, this is the kind of environment that Trump seems to really enjoy and thrive in, is these kind of, sort of long, rambly campaign-style speeches here. I mean, what Trump is ultimately trying to do with a rally like this just outside of Detroit, I mean, he's defending his agenda, really, right? He's obviously been facing quite a lot of headwinds over the last couple of months since he took office 100 days ago. This idea of his economic agenda backed by these tariffs, which have seen his, popularity dropped significantly. He's not polling particularly well with the American public. Obviously, we're seeing a lot of uncertainty over these tariff plans with, various companies. Investors obviously are really scratching their heads trying to get a handle on what exactly Trump is doing here. Well, he really used the speech as an opportunity to tout that economic plan as one that was worth having. He's really defending these tariffs, even if obviously there have been many adjustments to them made over the last, several weeks, as we've seen, sort of this rocky rollout of, these various sectorial and reciprocal tariffs. But yeah, I mean, the ultimate line that Trump is trying to deliver here is that this is the right economic policy and that it's going to pay dividends in the end.
And he really couldn't help himself criticizing Fed Chair Powell again.
No, I mean, I think this is, the other side of Trump that you really see with these kinds of events is this really push and pull between, some of his advisors who may be telling him, how to speak about the Fed. He even was, as he was criticizing Jerome Powell, saying he's not really doing a good job. He was saying, the Fed's supposed to be independent. You're not supposed to criticize the Fed. Kind of reads like, maybe what he knows that, others may be telling him. But ultimately, yeah, I mean, you're seeing again sort of that push and pull here. Donald Trump has really loved over the last several months to criticize Jerome Powell, kind of dictate the path of interest rates. He was just saying at this rally that he knows interest rates better than Powell does. But again, you kind of see that back and forth because as we had heard over the last couple of weeks, his advisors were actually kind of advising him on whether or not he could fire Powell. He kind of walked that back a couple of days ago. Now here he is criticizing him again. You're right. He just really can't help himself sometimes.
What's really been interesting is that we've heard from President Trump as well as a number of his, top colleagues, including the Treasury Secretary, that the pressure is on China, right, to come to the table, to make a deal, to offer concessions. That isn't necessarily what we're seeing from Beijing in terms of any kind of willingness.
No, I mean, look, at this point, there's still not really any formal talks between the U.S. and China right now. And you really kind of see Beijing digging in their feet a little bit about this. I mean, we saw just a couple of weeks ago, Chinese officials were saying essentially they need to have some kind of, terms and conditions to even come to the negotiating table here. Now you've got Donald Trump riffing at this rally saying that, he thinks they will make a deal, but also they deserve the tariffs. Again, it's really that kind of juxtaposition between this Trump that wants to be very strong on these tariffs. I mean, 145% tariffs on China. He even acknowledged today that's essentially an embargo on, sending over Chinese or, taking in Chinese goods. At this point, though, again, there's really not a clear pathway toward what a deal between the U.S. and China looks like right now. We still don't really know what that negotiating table is going to look like. You still have two sides here that have really just kind of dug in on, their own expectations for a deal. And there's really no clear pathway toward, what some kind of negotiation would ultimately look like.
Bloomberg News Desk editor Joe Dasis there. As we mark those 100 days in power for President Trump in his second presidency, take a look at some of the other stories that we're following this hour. And Amazon says it will not display the cost of U.S. tariffs on its products after President Trump called Jeff Bezos to complain. Shares paired earlier losses inflicted as the White House described the idea as a hostile and political act. The proposal was initially reported by Punchbowl News, but the company now says the tariff label is not going to happen. Bloomberg has learned that President Vladimir Putin is insisting that Russia take control of 4 regions of Ukraine it doesn't fully occupy as part of any agreement to end the war. The demand deals a blow to President Trump's efforts to reach a ceasefire. Sources in Moscow say U.S. envoy Steve Witkoff tried during lengthy talks last week to convince Putin to agree to a ceasefire that's based on the current front lines. Spain's power grid operator says a series of disruptions over a few seconds triggered Monday's widespread blackout, which spilled over to Portugal. However, Red Electrica says it still doesn't have a complete explanation. The Spanish government is not ruling out a cyber attack, although the grid operator denies any hacking. Prime Minister Pedro Sanchez has also denied opposition claims that expanded wind and solar generation were to blame. The European Union's top court has banned so-called golden passports for wealthy immigrants. It's ruled that Malta's program for investors is illegal because it renders nationality as a mere commercial transaction. The US, meanwhile, is offering a so-called Trump Gold Card, granting residency and a path to citizenship for investors paying $5 million. More ahead on the Asia trade, this is Bloomberg.
We're watching Toyota in the trading session today after Japan came back from holidays. Chairman Akio Toyoda is attempting to buy out Toyota Industries in a $42 billion deal. The proposal is raising questions about corporate governance. This would really tighten the grip of Akio Toyoda over Toyota Motor and Toyota Industries. The deal would represent a roughly 40% premium over its market cap at the close on Friday. We have more ahead. This is Bloomberg.
Take a look at what we're watching across the FX space. Of course, question marks being thrown up again when it comes to the resilience of the US dollar after those comments that we heard in his 100 days of speech from President Trump. And again, that renewed criticism of Fed Chair Jay Powell. We did see in the previous session the dollar trading higher versus all G10 currencies. There were some reports that the administration was looking to, of course, the signing of, in fact, that document when it comes to the lessening of the impact of the auto tariffs. So a bit of a tweak to that policy. We saw a decline in the euro as well after we saw some inflation expectations data or survey data approaching a one-year high. Watching dollar China as well at the moment. We are expecting the PMI numbers, and they should, at least when it comes to the manufacturing side, start to show the implications of course, this trade war that kicked off over the past few weeks. The manufacturing PMI expected to fall into contraction territory. Non-manufacturing or services, I should say, expected to see some weakness as well. We did see the yuan gaining on a bit of a stronger fixing, but of course it's ahead of the May Day holidays about to kick off in China. We're taking a look at those PMI gauges, both services and manufacturing. They are due out later today for the month of April. Those readings likely to come under pressure with this ongoing trade war, settling back from what we saw in March, which was a bit of a seasonal bump. Non-manufacturing, though, we could see still signs of expansion there, pick up in construction activity. Let's bring in Peiqian, who's an Asia economist at Fidelity International. Peiqian, really great to have you with us. So, extract for us what you expect to see in terms of these PMIs, obviously forward indicators, what they tell us about the broader macro environment and the geopolitical situation with trade.
Thank you for having me today. We are expecting the PMI numbers, both official and Caixin number, to show moderate contraction in this month's print because the tariff has been taking effect in the month of April. But that being said, I think this is still a development that's unfolding. So we're not going to see the full impact at one go. It's probably going to develop in the coming months and weeks. So more specifically, within the PMI indicators, we look for signs in employment sub-indicators as well as forward-looking indicators such as export orders for gauging the real impacts that we see so far.
Are we starting to see some of the implications when it comes to sentiment, though? Because we know that there's been a lot of uncertainty over how factories and producers are going to deal with these tariffs, and not just the tariffs, but of course the supply chain disruptions as well, right? How do we see that through the prism of this set of data?
I think you've rightly pointed out that the main impact we're going to see likely in today's data is the uncertainty elements of the tariff that's being hit so far. There are some degrees of flexibility, it seems, around the tariff rates eventually, and we probably will not be able to see the full exporters' adjustments while they are adapting to the new regime of tariffs. But nonetheless, I think that print is still going to give us some hint on the initial reaction to such a large size increase in tariff rates.
How well are Chinese policymakers right now padding the economy for all of this uncertainty?
I think judging on the latest Politburo meeting statement last week, it does appear to us that the policymakers are standing ready in reaction to what's likely going to happen in the economic front. But it also tells us that they remain reactive over what's likely going to come, because we don't really see additional aggressive stimulus being rolled out in this meeting yet. And I think they probably will still adopt a wait-and-see approach to assess the real tangible impact of the eventual tariff hit.
How do you expect the composition of the fiscal measures with the monetary measures to really evolve over the next year as we continue to see the trade tensions unfold?
I think in terms of policy actions, we don't really rule out really aggressive policies if the tariff impact is really substantial and material. But as the as I mentioned earlier, the development is still evolving, and uncertainty is really the key theme that's hovering around global supply chain, global trade at this moment. So I think in the very near term, policy will likely to remain targeted with a priority to stability in the employment sector as well as social sector. But going forward, as we see more impact unfolding, it's likely that policy will become much more broad-based and much more stronger.
That broad-based policy that we could see it transitioning into, does that suggest a return to the old kind of stimulus-driven growth playbook? We are already expecting to see sort of more construction activity, sort of infrastructure investment, fixed assets, where we're going to see that boom again?
Well, I think in terms of the composition of the broad-based policy that we are envisioning in a very large downside scenario, it's likely going to be more balanced rather than a very decisive pivot into domestic demand and consumption. I think the officials and policymakers recognize the important aspects of supporting both consumption and manufacturing. So I do expect policy stimulus to be rolled out to support both investment in a continuous manner in terms of the manufacturing sector, as well as delivering more stimulus into the consumption sector to support the domestic demand as a shock absorber of what's likely going to happen as the external demand get worse going forward.
Peiqian, when it comes to Asian economies trying to absorb that shock from the ongoing trade war, of course, we usually focus on China, but we're now seeing also other economies, especially specific sectors like semiconductors, automakers, already seeing the hit. Who are the most vulnerable at this point in time?
I think, again, during this uncertain period, Asia economy is not in a really a strong position. They probably face double whammy hit from both uncertainty as well as the direct impact from the rising tariffs. But in the long run, I think the position of each Asia economy largely depends on how the tariff rates eventually settles. As you mentioned earlier, the sectoral tariffs in auto, pharmaceutical, as well as semiconductors, they do have different outsized impacts on each economy. That's precisely based on the allocation of supply chain, and each economy is geared towards different sectors. So the tariff policies will likely to have asymmetrical impacts on different Asian economies, but more broad-based if we think about the tariff on the universal tariff front as well as reciprocal tariff front. I think Asia economy will likely to see mixed impact from both the direct downside risk from tariff, but also they might benefit from diversion of China if the tariff differential remains at a high level.
Peiqian, always great to have you with us. Peiqian Liu, who's the Asia economist at Fidelity International. Well, President Xi Jinping's diplomats are fanning out across the world with a clear message for countries cutting deals with Donald Trump. The US is a bully that can't be trusted. Let's bring our China correspondent Min Lo in Hong Kong. So, Min, this is beyond just a sort of a charm offensive, right? This is really trying to position China as being a champion of the rules-based order and urging both rivals and partners alike not to trust the Trump administration.
Yes, indeed. And it's starting to feel like a pretty coordinated campaign because you look at how China has been extending the olive branch to some of its regional rivals, including Korea, for example. China is actually hosting the first all-Korean pop concert next month, the first in 9 years after an informal ban was put in place in retaliation to Korea, allowing the U.S. to set up a missile system there. And then with Japan as well, Premier Li Qiang writing to Prime Minister Ishiba calling for both countries to come together to jointly counter Trump's tariffs. With India as well, the ambassador pledging that China will not be engaging in dumping or cutthroat price competition and offering to buy more Indian products to balance trade. And the ambassador to Australia also penning an op-ed there, really blasting the U.S. tariffs, saying it's causing the world to return to the, quote, law of the jungle, and also blasting how tariffs are hitting those sub-Antarctic countries with penguins headwinds also not being spared. And meanwhile, you have these lower level officials, leading delegations hitting the roads, going to places like Latin America, bringing some companies with them in order to seek new markets, at least according to sources. So it's a pretty coordinated approach across, different parts of the government. We had seen how the Foreign Ministry also put up this 2-minute plus long video. It's now being carried on state media, on X, on WeChat in both English and Chinese, and really saying that essentially bowing down to the U.S. is equivalent to drinking poison to quench your thirst, and giving all sorts of examples of how the U.S. has done this in the past, limiting Japanese exports in the 80s and eventually leading to Japan's slow growth for many decades.
We are also seeing this coordinated attempt from Beijing to try to really decouple, and even from the United States, especially when it comes to drug makers, hospitals reducing their reliance on U.S. products?
Yes, that's right. And the timing of this is pretty interesting because we are hearing from sources that authorities have been asking drug makers and hospitals to look into the feasibility of replacing U.S. imports. And this came as early as after Trump came into power, suggesting that it was quite a preemptive move early on for China to take steps to protect the vulnerability of the Chinese medical supply chain in preparation for potential decoupling. And we know that Chinese hospitals rely heavily on U.S. imports for things like ultrasound machines, MRI machines. Drug makers import everything from cultures, medium, as well as drugs, antibiotics, and so on. And some of these cutting-edge gears, they are going to be quite difficult to replace domestically, especially when manufacturers may not necessarily have that level of technical sophistication. It's going to take time as well. If Chinese hospitals find alternatives, it will take time for authorities to approve them for the safety standards and so on. So it highlights the vulnerability that China faces here. We know that Trump, for example, has threatened sectoral tariffs on pharmaceuticals, and that Wall Street Journal had reported that China had quietly exempted some medical products from the 125% tariffs that China imposed on U.S. goods. So it shows the efforts that China is going to ensure the long-term stability of its supply chain.
Bloomberg's China correspondent Mehdi there. We're also watching the auto sector. President Trump, in his speech marking his 100 days in office, saying that he wants to give automakers a little bit of a break and time on tariffs. President Trump has signed a pair of directives easing some of the impacts from U.S. tariffs on automakers. The move comes after weeks of intense lobbying from manufacturers, parts suppliers, and car dealers. Let's bring in Bloomberg transport reporter Danny Lee. Danny, so how is he easing the pressure on these car makers?
Yeah, Shery, good morning. So President Trump was in Michigan on Tuesday to announce that in the first of two directives, he would sign an order on foreign imported cars coming into the U.S. They will avoid stacking on multiple duties, so they won't necessarily be dutied on stuff like aluminum and steel as well. So that was also a concern of the auto industry, but very much the auto industry, avoiding the kind of worst case scenario with regards to tariffs. I mean, in the second round of orders, President Donald Trump has said that the parts, foreign imported parts going into US-made cars, they can receive an offset of 3.75%. But this is a temporary reprieve spanning over a couple of years, and very much President Donald Trump wanting to make sure that things like parts that go into these cars are actually made in the US. So the kind of reprieve that the auto industry gets is a partial one, nothing like the kind of climb down that it had been seeking over the many, many weeks of intense lobbying.
What's been going on that we know of in the background in the run-up to these, as you say, the tinkering, the tweaks to the auto tariffs, and who could we see actually benefiting?
Well, we have seen a lot of lobbying, but we've also seen a lot of public proclamations. We've seen warnings from the likes of Ford Motors and even GM, General Motors, recently withdrawing its guidance because of the uncertainty around the the tariff policy. But generally speaking, it is that level of uncertainty that corporate America faces, which makes it very hard to understand what these tariffs mean, and particularly when it comes to potentially having to raise prices to cover the cost of these tariffs or pass on these costs. And so very much the US majors, auto majors, do stand to benefit, and potentially some foreign automakers as well, particularly those who are straddling the borders of Mexico and Canada. But it does still remain to be seen, given that these tariffs still exist, what impact that will have on ultimately car sales and the sense for consumers going forward.
Bloomberg transport reporter Danny Lee there. We're hearing more from President Trump in this ABC television interview, where he's sort of reflecting upon the moment that he had with Vladimir Zelensky in Rome. Of course, that was the sort of remarkable photos that we saw from Pope Francis's funeral. There was a moment of solace characterized by President Trump in this interview, saying that he does think that Putin wants peace. Of course, this coming against a backdrop of reports that Vladimir Putin is insisting that Russia can take control of 4 regions of Ukraine that it doesn't fully occupy at the moment as part of any agreement to end the war, as opposed to the boundaries being drawn at the current front lines, which is where those ceasefire negotiations have been at the moment, as being pushed by the US. So we continue to watch that. We've, of course, heard commentary when it comes to how Trump is approaching China, saying that China will eat those tariffs, that China deserves the tariffs that have been imposed on those exports, and saying that Beijing could find a way to reduce the impact on American consumers, but acknowledging that 145% tariffs amounted to a near embargo. Taking a look at how we're watching commodities at the moment. Oil in particular is set for that historic April sell-off, as the outlook is increasingly darkened by this ongoing trade war. More ahead on the Asia trade. This is Bloomberg.
Goldman Sachs CEO David Solomon says he's expecting markets to settle down after experiencing wild swings in the first 100 days of President Trump's second term. Speaking exclusively to Bloomberg, Solomon also told us he's awaiting more clarity on the direction of the president's policies.
We're 100 days in, and I would say there are a handful of policy initiatives that are being put forward. Some of them certainly are very, very interesting and intriguing to the market. But what's been put forward on trade so far has raised the level of uncertainty very significantly. And so I'd say 100 days in, we need another 100 days to kind of see where the policy directives are going and to try to have a better understanding of how what's talked about so far, particularly with respect to trade, is ultimately going to be put in place, how it's going to play out. But the policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy for investment and growth. And I think it's going to be important that we get more clarity on the direction of travel from here.
What, for the markets? So if you look at markets, there's been a sell-off, a pretty dramatic sell-off in U.S. assets. It's somewhat come back, but has it been too drastic?
Well, it's not just for the markets. You know, first and foremost, it's for businesses, it's for individuals. When there's a high level of uncertainty, people tighten their belt. They invest less, they spend less, and all those things slow down growth. And so, you know, one of the things that has happened over the course of the first 100 days is that the perspective on forward growth has been decreased. And so when you decrease, you know, that perspective on forward growth, that changes investors' perspective of equity values. So what we've seen is a relatively orderly kind of repricing of equity assets. And what's unusual in the context of this repricing is generally when you have that kind of equity market stress, people run to treasuries or safe haven, but here we're seeing a slightly different rotation because of the nature of the policy. We've seen a weakening of the dollar, you know, at the margin, and so that's been different than I think what people expected.
Well, are treasuries still a safe haven?
I think U.S. treasuries absolutely are a safe haven, but you can reprice a safe haven asset as people's preferences shift slightly. You know, I think at the margin, we've had for a long period of time a trend of capital flows into U.S. assets. And, you know, at the margin, people are looking at their portfolio constructions and saying, given the uncertainty that's been raised in the U.S., do we want to rebalance that a little bit? And I'd say the rebalancing so far has been at the margin. Investors can rebalance their portfolio in 2 different ways. If you're over here in Europe, and you have a European investor, they can sell U.S. assets. But also if the relationship between the dollar and the euro changes, that rebalances their portfolio weighting too. And so we've seen that over the course of the last few weeks.
Goldman Sachs CEO David Solomon there speaking exclusively with our colleague Francine Lacqua. More ahead on the Asia trade. This is Bloomberg. President Trump says China deserves the steep tariffs imposed on their exports and predicts that Beijing could find a way to reduce their impact on American consumers. Let's take a look at how this plays into market trading today. Bloomberg's managing editor for Asia Equities, Lian Ting Tu, joins us now from Singapore. And so, we continue to see the to and fro, and actually mostly kind of the to, right, when it comes to what we're hearing from President Trump and the likes of Scott Bessent to Beijing. But how is that impacting trading? Because onshore volatility for Chinese equities has been quite subdued, despite a lot of the geopolitical news, the trade bombs still being traded.
Yeah, indeed. It is all thanks to the national team, and China did deploy quite a few sovereign wealth managers to support the market. And as a result, as you mentioned, volatility for onshore stock trading has hit a record low. We're talking about 10-day volatility for the CSI 300 index at around 2 points. And that is super, super low compared to global volatility index such as the VIX, which is still trading at more than 20 points, which is above the 30-year average. So I think it is national team is creating a little bit of an unhealthy environment where, basically there's every sell order would have a buyer on the other side of the trade. And it is also masking this relatively positive trading environment in China, when most of the stocks in the Shanghai Composite were actually in the red for the past few days.
We're in the thick of earnings season. What are we seeing so far there?
Yeah, it is quite a mixed picture, Shery. If you look at the traditional sectors such as banking and real estate, the picture is actually not quite rosy. The big four banks reported earnings yesterday. They all reported a drop in profit, and that is because of the stimulus that has been rolled out, which means a cut in interest rates and mortgage rates cut as well. So that is really weighing on the net profit margins for these banks. And if you look at real estate, Vanke also reported widening losses in the last quarter as well for more write-downs and weak property sales. But there are also some bright spots too. If you look at BYD, which is a bellwether in EV sales, and they have reported blockbuster earnings, and also PopMart, which is a darling toy maker for Gen Z, and they reported very well on good earnings too.
We'll have to leave it here. We're running out of time. Bloomberg's managing editor for Asia Equities, as we of course head towards that China Open. Take a look at how futures are trading. This is Bloomberg.